All eyes were once again on the US on Wednesday as the FOMC meeting minutes were released and Federal Reserve Chairman Ben Bernanke spoke. Gennadiy Goldberg of TD Securities joins me now on the phone to discuss market response. Gennadiy, in what seemed a very repetitive ream of material, what new information did we receive?
Well, in all honesty, not very much. We didn't really receive much new information. Bernanke has been essentially saying the same thing over and over and over again since he first spoke in May, since the markets overreacted, since he laid out the plan for the Fed's eventual withdrawal from QE. What we did see from Bernanke was the emphasis of the labor market risks and the lower inflation. So he did come off as quite a bit more dovish, just because of what he chose to emphasize versus versus emphasizing the eventual exit itself.
America's biggest banks are among the heaviest borrowers from the Federal Reserve's unprecedented liquidity. The Federal Reserve's plan for paring central bank bond purchases could squeeze 2014 capital. Are we seeing evidence of nervousness within the banking sector?
I think, we are seeing some stories come through about reserves and how the banks will have to mark their books, I guess, once the Fed begins to extricate itself from QE. But I think as long as the Fed manages to frame a very gradual exit from QE, it shouldn't be much of an issue. I think the nervousness that's coming through is mostly a factor of an uncontrolled rise in yields, so maybe a 2 or 3% jump in interest rates. That's what a lot of the banks are nervous about, because that would make their reserves much less valuable, and they would actually take book losses on their holdings. I think as long as the Fed manages to keep the rise in interest rates at a gradual pace, it shouldn't be much of an issue.
So far in market response, we've seen Asian stocks rally and the Indian rupee also advance. But in the longer term, what does tapering mean for the US dollar?
Well, I think, since we are the first to, begin extricating ourselves from easing, it should be positive for the U.S. dollar. We're looking for a strong dollar going forward, mostly because, we were first into the crisis, now we're first out. The U.S. is still looking very solid in terms of the fundamentals. The labor markets are improving. We have a very positive investment outlooks, and I think the future growth story for the United States is quite good, and that should help support the dollar going forward.
Mr. Bernanke will also testify next Thursday. Can we expect the markets to hold their breath, metaphorically speaking, every time the chairman's expected to speak? Or have US watchers been placated for now?
Well, U.S. watchers are never placated. They always want the next remark from the Fed chairman. And, he has spoken quite often over the last few months. This is almost very unusual, and this is probably a way that the Fed's managing the market's expectations. He did mention that, the market did get a little bit too far away from what the Fed was saying, and that's probably why the chairman has scheduled a lot more appearances. Obviously, this one is more routine than the others. I don't think he's going to essentially say anything particularly new. He will probably continue to hammer home the same point that he's been making for the last 2 months, that tapering is not tightening, and that the Fed will keep rates on hold for a very long time to come. And I think that should help placate markets further.
Gennadiy, many thanks. Tomorrow may be the last day of the trading week, but the Dukascopy TV team will be keeping you up to date on all of the latest happenings. Goodbye for now.